Hey, when your plan is simple as stupid, you actually know what to do. You can make decisions, and that's how you start winning. We can just call it the box strategy. And here's the deal. All you gotta do is draw a box. That's it. Here's how. Every morning when you open your chart, you gotta find two prices from yesterday. You need to know yesterday's high price. That's the highest price that the market hit the day before. And you need to know yesterday's low price. That's the lowest price it touched. Just find those two prices from yesterday. Now, you can take those two prices, yesterday's high and yesterday's low, and you just put them on your chart for today. Draw a line right across the chart at the price where yesterday's high was. Draw another line at the price where yesterday's lows was. So, the space between these lines, that's your box. Those two lines, yesterday's high and yesterday's low. That's gonna be your guides for the whole day. Alright, so check out this example right here. See how the market opened up and then it was straight to the top line of our box, right to yesterday's high. Now, I gotta be honest with you. When I was first learning this stuff, I totally missed what was happening here. I'd see the price shooting up like that, hitting that top of the box, and I think, whoa, a strong move. Looks like a breakout, you know? Higher high, higher low happening on a smaller time frame maybe. And guess what I do? I try to jump in and buy the breakout. I'd enter the long trade right there, hoping it would just keep going up, and I'd put my stop loss order like just below my entry, thinking, okay, this looks like a solid setup, plenty of power here. But man, most of the time, boom, a stop out, trade over, and I've been sitting there so confused, like why did I get a stop down? It had so much momentum, the market must be against me. I get super frustrated, not understanding at all why my trade didn't work. Here's the point, here's the crucial thing I finally figured out, that the top line of the box we've talked about, yesterday's high, that spot is usually where the biggest sellers are hanging out. Think of the huge players, the institutions. They see the level and they're ready to sell a ton. So the price goes up there and it often just bump into this massive amount of sell orders. It tries to hang around, maybe wiggle a bit, but the big guys are putting their sell orders right there. And what are we? The regular traders often doing? We're trying to buy exactly where they're trying to sell their huge positions. We're buying into their selling pressure. That's why we get stopped out so much there. That's what I was missing. So here's the number one rule for this whole strategy, the most important one. Seriously, you ready? You never ever buy when the price hits the top of the box. Do not buy at yesterday's high. Why? Remember how the price got out there yesterday? The buyers who pushed it up all the way up to that high point, by the time it gets back there today, they're usually worn out. They're done buying for a bit. And guess who is active right there? Those huge sellers we talked about earlier. This is exactly the spot where the big institutions have a ton of sell orders waiting. You seriously do not want your little buy order to be the thing that lets them sell their huge positions. You don't want to be the liquidity. Basically, the buyers that they need to get filled on their sells. Your buy orders just helps them out right before the price probably drops. Stay away from buying there. Alright, so that was rule number one. Don't buy at the top of the box. Now, for the second big rule, it's the exact opposite mistake. You do not sell when the price hits the bottom of the box. So don't sell at yesterday's low. Why would you not sell there? Because just like the top of the box had ton of sellers, the bottom of the box, yesterday's low, that's where all the biggest buyers are waiting. They're the huge committed institutional buyers. When the price drops down and touches the low line, it often finds all those buyers sitting there. And if there are enough of them, the price can actually bounce and start heading back up. So you're gonna flip the script on what most struggling traders do. Instead of selling into those big buyers down at the low, we actually want to be buying down there, just like the big institutions are doing. Our plan is to buy near the low of the box and sell near the high of the box. Why does this work? Because guess where most smaller traders who are trading breakouts put their stop losses? You got it, right outside of the box lines. The big traders know this. They know exactly where our stop losses are waiting. This strategy puts us on the side of the guys who know where all those stops are. Alright, another super important rule. This one's really key. See the box we draw? If you sliced it exactly in half, right through the middle, that line would be our midpoint. Here's the rule. Do not trade right there in the middle of the box. Seriously, stay out of the middle. This is super important, especially right after the market opens. Think about it. The market is trying to figure out where those big buyers and sellers are. You know, they're hanging out mostly at the top and bottom of the box. The middle part, that's just where all the random noise and choppiness happen. You do not want to get stuck into low quality trade in the messy midline zone. That's not much good opportunity. Not much premium trading there. You'll just end up getting stopped out for no real good reason because the price is just bouncing around randomly. Listen up everyone. So check this out, right? We're gonna draw this box simple from the high of the previous day all the way down to the low of the previous day. Got it? High to low. Now we just put a little line at the high point and another line down there at the low point. See, got those lines drawn, right? High and low from yesterday. What are we waiting for today? The market opens up, things get going, and maybe the price pushes straight up and hit the high line we draw. Bam. Okay, when that happens, that's where your antenna should go up. You might be start thinking about a sell trade, maybe going short. Now, same idea down here at the low zone. Price just zips right down and hits that low line from yesterday. Cool. That's your cue to maybe look for a buy setup, thinking about going long. And seriously, this is the most important part, guys. Pay super close attention. We are not just blindly buying cause price dropped to the low line or blindly selling cause it hit the high line. No way. You gotta wait for something special to show up right at either of those levels, at high line or low line. We're looking for a specific pattern or setup that screams, okay, the real buyers are stepping in here if you're at the low line, or okay, the real sellers are showing up if you're at the high line. It tells us the big players want to protect this level. I'm gonna show you guys that exact candle setup you need to look for in just a minute, so stick around. Hitting the line just puts you on alert. You gotta wait for the market to confirm your idea with these candles. Makes sense, right? Simple. But we draw the box from yesterday's low to yesterday's high, so we have it. Alright, let's see what happens around this area. And look, price actually keeps going lower for a bit. See how it looked kind of weak? And you know what? If I saw this when I was first trading, I'd get worried. I might even think, oh man, it's breaking down. Gotta sell. I might try to short it right here. And guess what would happen then? Boom. Stopped out again. Super frustrated. Not understanding why my short trade didn't work when it looks so weak. But remember what we talked about? This premium zone, yesterday's low. This is where the biggest buy orders are stacked up. And all those stop orders from people who sold higher up, a bunch of them are sitting right below this low too. Institutional traders, they know this. So what do? They see all these buy orders waiting and all those stops below. They often try to push the price up just to hit those stops and get their own big buy orders filled. Alright, let's move on to the step 2. This is where I show you exactly what we look for. The signal to actually get into a trade. Alright, so real quick, let's just sum up step 1 again. As simple as stupid, right? Step 1 is all about finding yesterday's high price and yesterday's low price and then drawing our box using those two levels. You do the first thing, right? Alright, so remember what we talked about? The top line of the box, yesterday's high, that's where the big sellers are, the serious ones. So the market opens up and watch. See it? Price is heading straight for the top part of our box. Now, we're at the top of the box, so we're looking for a short entry here. But remember, we do not just blindly sell because it hits the line. We need a signal. We gotta see the market get rejected from this level. We need a specific candlestick pattern to show us sellers are already stepping in. I look like for this candle setup. It usually looks like price tries to push up, maybe makes a new high, but then sellers immediately smack it back down, leaving a long wick on top of the candle, and then you see a red candle follow right after. The whole picture tells me, okay, sellers are probably taking control here. And look, see right here on the chart, that's the green candle pushing up with the wick on top. Then a red candle takes over. You might see a little choppy action. So another wick on top right there. Sometimes price even pokes just a tiny bit above our box line. You know why that happens? That's often the big players trying to grab all those stop losses sitting just above the line from people who tried to short too early. It's them getting the liquidity they needed. Okay, So this first clear red candlestick right here, that's our signal, our candle setup. So how do we enter the trade? Your entry happens as soon as the price starts dropping below the low point of the signal candle. And your stop loss, you place it just a little bit above the high of that same signal candle. Now, quick note on stops. This is important. Do not make your stop loss super tight. Do not put it exactly right on the top of the line of the box. Why? Because as we just saw and like we talked about, this zone is where those big sellers and institutional traders are grabbing liquidity. They're trying to trigger stops just to push the price the other way. If your stop is too tight, you might get a stop down from no good reason right before the price moves in your favor. Give it a little room to breathe slightly above the signal candle high. Where do we actually get out for profit? Good question. You've got a couple of cool options here with this setup. One way, maybe the quicker, safer way for some trades, is to use the midline of the box we draw. Remember, halfway between yesterday's high and low. The midline can be a solid spot to take some profit off the table. Lock it in. Or if you're looking for a bigger move, you can set your take profit all the way at the other side of the box. So if you bought down at the low line, you could target the high line. Or if you sold up at the high line, you could target the low line. See? You're basically looking to ride it across the range. So yeah, midline for quicker win or the opposite line for potentially more profit. Totally up to you. And this is something people ask me a lot. What do we do when price breaks out the box? This is a perfect example. And I want to show you a trade setup you can look for specifically when price breaks out of the box like this. So yeah, we break out below yesterday's low here. But then look, price actually reversed and came right back up to test that low level again. So here's the plan for this situation. As soon as the market opens, I'm watching this exact area, yesterday's low, because it was just broken. I want to see if it holds as resistance now. Well, seller steps in here just like they did at yesterday's high. Remember yesterday and maybe the day before, we saw that buyers weren't strong enough to hold this level, and we saw sellers taking control higher up. My plan is the same. I'm waiting to see if that old low from yesterday gets tested again. If price come back up to this area, I'm getting ready. I'll be waiting for a very specific candlestick pattern, that signal we talked about, and I'll be ready to hit that short button again. Okay, price just shot into this area. Now I'm looking for my signal. I want to see a red candlestick form right here. That gives me confidence that sellers are stepping in again at this level. Remember, this was yesterday's low and it looks like it got rejected, acting like resistance now. And there it is. We finally have our red candlestick. See the wick on the top? That looks like our entry candlestick pattern, and it happened exactly at our resistance zone, which is also right at yesterday's low. So based on that, I want to go short. My entry happens as soon as the price drops below the low of this first red candlestick, hitting the sell button now. My stop loss goes slightly above the high of that signal candle. Now for the target, you can aim for a recent swing low in the price action, or you could just trail your stop loss. Okay, that was the simple strategy. Hope walking through those examples made sense. Thank you so much for watching, and I can't wait to see you back here on the channel again soon.